All right. Good afternoon, traders. Some of you, good afternoon again. Hopefully, a lot of you are coming from the trading room. I gave very specific invitations to join me for this active investor workshop. This is an audible. This was supposed to be, I believe, weekly versus monthly options. So real quickly, weekly options expire every week. Monthly options expire the third Friday of the month. Boom. Now you know. Now you can't see? Oh, thank you, Phil. Now can you see? Yes. Good afternoon, John. Yes, it's recorded. Hello, Dennis. Good to see you again. Hello, Phil. Thank you for letting me know. All right. Well, I'm a little sad because our numbers are light here. I say anytime the market struggles, we tend to see attendance drop when I would think like that's exactly when you would want to come and be like, all right, what do I need to do to get through this? Today, we're going to talk about market posture. My name is Scott Beck. I'm the head trading coach here at Tradespoon. I've been trading for over 20 years. I've been teaching for going on about 18 of those years. I think it's actually getting close to 20, to be honest with you. I think it's like 23 or 4 years of trading now, and I don't feel that old, but I guess I am. I need to remind you that options, well, you know what? We're not really talking about trading strategies. So I'm just going to put this up. If you've never seen it or heard it, read through it. But I'm going to just kind of pass through this pretty quickly. There's the disclosures. You've been warned. You've been warned. What are we talking about today? Now, I'm going to share this now. I'm gonna send this out once now. I'm gonna just reply to somebody's message. This is a Gmail, or this is an email address that I use. Deliberate trading. If you don't already have it, some of you probably already do. If you've ever requested something from me before, send to all. I'll send it again at the end. Okay, so you should have received a message. Oh no, I think oh no, I spelled it right. Deliberate trading at gmail.com. Did everybody get that? It's hard to share documents through this. I'm not really all that familiar with how to do it. So rather than waste time, you can either A, just kind of make a note of this, or B, you can send me an email and just say, hey, Scott, can I get the spreadsheet and the links? I'll put a couple of links in there too to make sure you have the right links. So this is it doesn't look like much, right? And I'll be honest, this is one that I teach with. I keep my own on a different computer. I probably should try to update this one because there's some gaps, but I've got a last little bit here. I'm gonna just kind of blank this out and we're starting over. April 24th was Sunday. This is a weekly routine. If you saw my full spreadsheet, you would see, I think this was actually supposed to be what was after January 30th. The 6th of February to 6. This is a weekly routine. I do it Sundays. That's when I like to do it. What am I doing here? I'm assessing the broad market. So when somebody says, when I say posture, my posture, what's my stance? That's when I'm bullish, bearish, neutral, right? If someone says, oh, are you bullish or bearish or neutral? I have a very specific answer that I would give. And it's based on this analysis. So let me just kind of walk you through this. You'll want to watch the recording again. This is out of 10 points, plus or minus 10. So every score in here can be plus or minus. And you can see right here, it gives you the scale. Long-term trend is 2 points. Short-term trend is 3 points. Volume, major market, and sector rotation are each worth 1 point, and the VIX is worth 2 points. That is the 10. Now, as I teach people how to do this, sometimes they get stuck like, oh, should this be a 0.63 or a 0.67? Or this isn't a formula. It's not like a, you have to specifically measure A versus B, and this is over that. This is let's organize our thoughts by objectively considering these 6 broad components of the market, and then we look at them all together. Because and this is an analysis I've done. This is an analysis I've done for 15 years, probably, at least, maybe longer. And it just sort of keeps my thoughts organized on the market. And it's very interesting because sometimes I'll see a shift in the market based on the major market analysis. Sometimes I'll see it in the VIX. Sometimes I'll see it in the sectors and how they're rotating. You never really know what might show up first that indicates a shift in market forces, market dynamics. And so what it does is it allows you to be as objective as you can, and that's the key, right? The reason I started doing this analysis is because I found that too many of the mistakes I was making in my own trading were coming because I was overly biased to my own opinion. Let me know if you can relate to that, right? I'd be like, oh, XYZ, that's bad, and now I'm bearish. Or, oh, this is good, now I'm going to do that. The gist of it is that we have such a tendency to overly be influenced by that opinion when we're making our trades, and we don't see something else. What it comes down to is inattentional blindness is what they call it, right? I think I've talked about some of the analogies to this or some of the stories I have, but if we're not careful, I don't want to get distracted too much by this, but if we're not careful, things will be changing around us and we just simply won't see it. We're just kind of like tra-la-laing along and not really seeing what's going on. Okay, so what I'm going to do is I'm going to analyze and score each component individually, right? I'm not going to look at the short-term aspect of the long-term trend because I'm going to look at the short-term trend. I'm not looking at support or resistance. This has nothing to do with trading posture. So when I talk about posture, I have a market posture, which is what am I overall? Bullish, bearish, neutral. Then I have my trading posture, which is what am I trading today? What am I putting on? Might be nothing. You might be neutral on your trading posture, which means either you're putting on neutral trades or you're not trading. Great. Okay. Fair enough. When I'm talking about my trading posture, I'm definitely going to be looking more at support and resistance. But when it comes to market posture, I'm really looking more at trend analysis. So you want to be very careful not to let any one of these bleed into the other. They will all be analyzed independently. Okay. Now let's get started. If you have questions, just throw them out, because if you have it, someone else probably has it too. What is this going to do for me? Well, it's going to help me to see if the market's getting better or getting worse. You can see that really it's been since January that I've been kind of on the bearish end of neutral. It started to improve a little bit in April. We all saw that, but not that much. Not enough for me to be like, oh, let's get a bunch of bullish trades on it. No, look at it. It never got that much better. If you look back in October, November, look at the scores: 2, 3, 5, 4. And then all of a sudden, right at the end of December, started to drop. And by January, even more. I'm not waiting for it to become negative. If I see a few straight weeks of dropping, my trading will be influenced by that. I'll say, oh, this market's worse. I need to change. I need to be careful about this. So it's not just the score you have, but the progression of the score. If I start to see this market, If we went from -2 to -1 to 0, zero's neutral, but I would say that's getting better, and I want to start trading more bullishly, right? So there's two things that I'm looking at. Number one, what is it now? Number two, what is it relative to what it's been? Is it improving, staying where it is, or whatever else? So yeah, John, definitely send me a reminder and I'll shoot it over to you. Now you'll notice what John asked about these sectors. So one of the things I would do is I would actually put what sectors I think are showing strength. And you can actually see that we've been noticing energy. So financials started to a little bit, but they dropped off. Energy, staples, industrials, and materials. When did I start noticing strength in those sectors? Back in January. January, right? That's when I want to be trading. What have those areas done since January? If I were to go look at January 16th, January 23rd on XLP, back here, right? Back here. Now, it dropped a little and then it's rallied since then. If we look at energy, here's January. What's it done since then? Nice and strong to the upside. When we look at materials, come on, materials. Materials not as much. Here you can see they've gotten battered, but you know, there we had that coming in and showing us where the momentum was. And energy definitely still strong. Okay. So let me know if you have any questions. Like I said, if you send me an email and just request it, I'll put together a little form response that will have this spreadsheet with a couple links so that you can just kind of continue to adapt it. I do, when I add something to this, I just insert and then I just do a quick copy and then a paste, and it just keeps it so that this spreadsheet flows to the left, right? And then it's all automated. So, okay, let's dive in. Long-term trend, 2 points. What am I looking at? I am looking at a 3-year weekly chart. 3-year. Cecil, I'll let me. I'm gonna just put it one more time, and then I'll send it one more time at the end of the session if anyone comes late. Boom. Okay. Okay. Now, what am I looking for? What am I looking at? Trend. That's it. Trend. So when you look back here, this was an uptrend. Now, the first thing that I'm going to tell you is I'm very reluctant to ever go all the way to 2, all the way to 3, all the way to 1. Why? Because once I've scored it at the strongest, it cannot get stronger. So if the market did improve, you would be like, oh, well, I can't really reflect that. That's something that I learned just from trial and error. And I will tell you, you do have to dial in on this analysis. You're not going to be comfortable the first week you do it. But the more you score it, the more you dial in, the more you're going to be like, okay, I have a good sense of what I think this market is, right? Again, we don't think we're building a crystal ball here. We're just organizing our thoughts on what we see out of the market. Now, during that time, I was scoring that anywhere from a 1 to a 1.5. I think most of the time I was here. The way I would have you thinking about it is like this. You don't really see long-term trends get much stronger than that, right? So if I were to have a scale, that's a 2, 1, 0, -1, -2. Well, what is it doing now? Well, you can see it broke the downside of this trend. And if I were to draw trend lines now, what would they look like? They'd look like that, right? So as of now, if it breaks this, I'm going to start to go negative. But as of right now, the fact that we have point here, point here, point here, point here, I'm seeing this as straight sideways. So I'm calling it a 0, right? I'm calling it a 0. I don't really have any higher highs in here. I really don't have much to call this an uptrend, right? So for me personally, if I'm going to be scoring, right, a positive 2 is a strong uptrend. A positive 1 is a pretty good uptrend. Now you can go 1.5, you can go 0.5, 0.25. It's up to you. It's your analysis. What would reflect that? 2 is as strong as it gets. -2 is as weak as it gets. How would you rate this? Right? That's what you're thinking about. Me, I am rating this sideways. So I'm going to give that a 0. If it starts to break down, I'm going to start to go -0.5. And if it comes up and hits a lower high, it's going to get -1 and then even -1.5. So I'm definitely very leery about that developing right there. But as of now, the long-term trend, I'm going to say is neutral, 0. Okay? Let me know if you have any questions. I'm just going to kind of move through this so we can get through, talk a little bit about the implications. Next thing I'm going to do, I'm going to go back to 6-month daily. Same thing. I'm trying to score the trend of the short-term market. Much harder sometimes. Sometimes not, right? We started to have a little bit of a downtrend in here, and then we reversed up a little bit. So what I will tell you is this: when you're scoring the short term, you've got to be much more aware of breaks, right? Where it's like, oh, it broke out here, so I'm going to give that an extra half of a point or an extra 1 point, no point there, an extra point to reflect that the buyers pushed it up or down. So as of right now, right, we kind of broke up and we came down and was trying to hold. And then what happened? Boom, it broke down. It broke down, and that was on Friday. So that would have been before even the weekend. But it broke down on increased volume. Therefore, how would I score that? Overall, you could make the same argument, right? But that's actually the same trend. That's the same trend. Right now, what do we have? We have this, which to me is showing downward, right? So I would score this anywhere between a -0.5, possibly even all the way to a -1, right? Depending on how much influence you give to this dropping down. So let me come back in here, and I'm gonna go ahead and I'm gonna be a little more steady with it. I'm gonna say -0.5. 2 weeks ago I was a 0.5. Right? You can see that this is gonna change a lot more frequently than this one is. A lot more frequently. Choppy is right, John. Choppy is right. That's, if we had to describe our market, we would describe it choppy, and we wouldn't be surprised at all to see our short-term trend going back and forth. Osama said, would you apply the SPY trend to other markets like QQQ? Do you have different tables? You know what? I don't. I'm going to expect them to be similar enough. So I use SPY for the long-term trend, the short-term trend, and volume. I use the same for all three of them. This, the SPY, that's the market to me. I don't really feel like I need to go look at the NASDAQ, the Russell, and the Dow differently. But remember that we're going to do a major market analysis here, where we actually look at the Dow, the NASDAQ, the Russell, and the S&P. So bear with me. But for now, when we say trends and volume, that is the S&P 500 for me. If you find that you trade a different market more frequently, certainly you could make an adjustment, but I just haven't felt like that was necessary. Okay, what's next? The volume. Okay, so for volume, now same thing. If it breaks this low, I'm gonna give it another -0.5 a point, and this is gonna go to -0.5, and this is gonna go to -1. So if things get worse, this will continue to accelerate to the downside. Volume, I'm going to go to a, I'm going to go to a 1 month daily chart. And what am I looking at? I am looking at the above average volume days, right? Above average volume days. And when you look at our above average volume days, I've got one here. I'm going to say that is sellers, 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 buyers, sellers. So I see 5 selling days, 1 buying day. Now we expect there to be usually more selling pressure than buying pressure. So, you know, this is not like, oh, I'm so panicky, but that certainly is showing that the sellers have more conviction than the buyers, right? That's it. If I see a tie, then this neither helps nor hurts my my market posture. If I see more up days on big volume, I'm going to score it positively. But as of right now, I have more down days on negative volume, on heavy volume. So what I'm looking at here is the sellers are showing a higher level of conviction, and I'm going to give it a minus 0.5. Right now, remember, it can go to a -1. For this to get to a -1, I'd have to have like 10 or 12 selling days and no buying days. I've never seen that. So again, what am I looking for? I'm looking for my analysis to reflect the fact that my long-term trend is neutral, short-term trend is slightly bearish, volume is slightly bearish, right? As we put all of these things together, it's going to help give us an overall score on what the market looks like and what our concerns should be. Okay, now I'm going to do a major market analysis. So if you, I'll send the link now, but if you want it, I'm just going to send this to whatever was just sent to me. This is the link. I send it to everybody. You should have got that. Major market analysis. This is just a chart from stockcharts.com. No need to even pay for a subscription to this. It's free. What do I have here? I have the NASDAQ, the Russell, the Dow, and the S&P 500. If you don't know which is which, you put your mouse over it and it tells you, right? So this is showing me, this is a relative strength chart. They're all 0 back here at the left. Where are they now? Well, you can see that the NASDAQ and the Russell are both down around 15%. The Dow and the S&P are both down about 4 or 5%. So what does it tell us? It tells us that money is flowing out of the NASDAQ and the Russell at a much faster rate than it's flowing out of the Dow and the S&P. What am I looking for with this analysis? Appetite for risk. What is the overall appetite for risk in the market? If it's a good bullish market, we should see a high appetite for risk, which means people are putting their money into the NASDAQ, they're putting their money into the Russell, where they have a higher probability of faster growth. Right? If you've got a higher appetite for risk, you want to, let's go. Let's invest, let's make some money. If you're feeling a little bit more nervous, a little more defensive, what are you thinking? Let's get our money out of the more aggressive things like the NASDAQ and the Russell and put them into the more stable things like the Dow and the S&P. So it's showing us a defensiveness. Now, this is just one time frame. And what do I see? I see defensiveness on this first time frame. What do I do next? I change the time frame. So if you look down here in the bottom right corner, 200 days, that's approximately 9 months. I'm going to go to 133. That's approximately 6 months. Or excuse me, yeah, 6 months. So 6 months ago, you start everything at 0. Where are we now? Same exact thing almost. S&P and Dow down 6%. Russell and NASDAQ down 16. So this is showing us a defensive in the market, and we've been seeing it for quite some time, right? This really started to score this way back in here. You can see the NASDAQ really started to fall hard. The Russell's been lagging for a while. So this is something it's not like, oh my gosh, where did this bearishness come from? It's been here. It's been showing us this, right? It's here. Still not done though, but this is another defensive looking time frame. Now I go to 66 days. These time frames are important because we're going to do this exact same analysis with sector rotation. This is the rotation. I can't see sector rotation if I look at one chart, right? If I look at a 3-month chart, I can't see rotation. In order to see rotation, I've got to be able to see momentum. In order to see momentum, I've got to have multiple time frames to see what's moving better or worse, faster or slower. Now I go to 66 days. This is now a 3-month type chart. You can see the Dow is still leading. All of a sudden, though, the Russell's like, hey, look at this. Look at me. Not too much. You can see the NASDAQ is the worst. But all of a sudden, we had a little bit of a pop. So it had been mostly defensive, and now all of a sudden, we have just a little eke of a sign of life from the Russell. Okay. Nothing great yet. I mean, nothing that's like, oh, look at that. People are moving back into small caps, but enough for us to be paying attention and to be mindful of what may be developing here. Then we go down to a 22-day. This is a 1-month chart. And on a 1-month chart, you can see all of a sudden that strength we thought we saw on the Russell seems to have disappeared. It's back down to the bottom, but we have a little piece of strength showing up from the NASDAQ all of a sudden. Over the last month, the NASDAQ is now the strongest market. Is that enough for us to be like, okay, here we go, here comes the NASDAQ? No. Again, this is about awareness. It's about, hey, be mindful of this, be watching this. Overall, how am I scoring this? Negative. More than not, it's negative, right? This is the only time frame where we have the indexes actually reporting positive returns just for the last month. But the last month is what's going to build into whatever comes next, so we want to be aware of it. So what is my score going to be here? I'm still going to score this a minus 0.5. Now, if I start to see more strength from the NASDAQ, more strength from the Russell, more weakness from the Dow, the more I see that, the more this will go less negative to neutral to positive. For this to be positive, what would I need to see? I would need to see the NASDAQ leading. I would need to see the Russell trying better, right? We don't need the Russell to be in position for the market to move. We definitely need technology for the market to move. So if the NASDAQ is not bullish, the market is not bullish. It's pretty simple. So that's why I don't necessarily score the Qs like I score the SPY, because I'm looking at that more as a specific component. Okay, questions? So 4 time frames, 200, 133, 66, 22. I'm scoring it when I get to the end to just kind of say, what does this mean? Overall, it means that it's mostly still defensive, right? Mostly still defensive. We're mostly still seeing the Dow and the NASDAQ holding on better than, or the Dow and the S&P. But there's a little bit of life maybe developing. So there we go. Okay, moving on. Sector rotation. Same analysis. And again, I'll send the link now. Copy to everybody. Paste, send to all. Okay, so you should have my email address and you should have these 2 charts. But if you send me an email and request, I'll send you this spreadsheet and I'll send you these 2 links so that you can, kind of model along. Can we get a written set of rules on how to, unfortunately, Ed, I don't have written rules, so I'm going to leave that up to you to transcribe. You have the recording. The recording's available, but I really don't have any like this. This is it's funny because it's an informal process that's gotten increasingly formalized through the years. But unfortunately, I don't really have any kind of like written manual about it. This is not like Tradespoon analysis. This is Scott Beck, trading coach. What's one of the strongest routines that I've taught over the years to thousands of people. Where are the recordings? Let me show you that. If you come in here to quick navigation and you come over here to free education event recordings, and you come here to active investor workshop, then pretty soon, later today, you will see April the 26th, and it's gonna say weekly versus monthly options. But when you look at the little thumbnail over here, it's gonna say market posture. So you can watch that again. So, I kind of called an audible, to give this presentation. I've had some requests about it. So that's where you will find the recording, my friend. Okay. Sector rotation, same analysis. Yes, same analysis this time. And this is why I like these charts here, because it's very easy for me to put my mouse over top and be like energy, utilities, staples, and so on and so on and so on. It's a very similar analysis. It's about defensiveness versus growth, right? In a strong market, what sectors would we expect to lead? I would expect technology. I would expect financials. I would expect consumer discretionary, maybe even industrials, right? Why? Because people are more bullish and they want to invest in things that are going to grow, which is technology. Things are doing well. Businesses and growth is being financed. So there's a lot of M&A activity and loans and everything else. So the financial institutions are doing well. Things are being built. So the industrials are doing well. People are spending money. So consumer stocks are doing well. In a defensive market, hey, John, you know what? I really have a hard time writing down emails. That's why I gave mine out, because it's so much easier for me just to hit reply. And I'll just, anyone who sends me a request, I'll hit reply with a kind of a form like, here it is. So I don't want to be responsible for remembering and then forgetting, and then you're cursing my name. No, but I don't want my name cursed. You know what I mean? So appreciate it. Thank you, sir. Okay. Now what? What's leading? And what does it mean? Energy is leading. Utilities are leading. Staples, not discretionary, not retail, not travel, discretionary. Food, toilet paper, right? Toothpaste, the things we need versus the things we want. What does that mean? It means that people are putting their money, the money is rotating and has been rotating into defensive components of the market. It's defensive. We don't love that, right? This is inflationary. Energy prices are up. Utility prices are up, right? What about our growth sectors? Communication services is by far the worst, right? Facebook, Twitter, etc., right? Things like that. What else is down? Technology down, industrials down, discretionary down, right? Even financials slightly down. What's above the market, right? The red is the market. What's above it? Healthcare, materials, staples, utilities, energy. Not good. This is not what we want to see. This is not a growth setup for market. We need to, for us to think that the market's going to get more bullish, we would need to see money rotating into more bullish sectors of the market. Yeah. Now you can see they've all pulled back, but that doesn't necessarily mean they're done, right? That could just be the pullback. That's where the strength has been, is across these. But what am I going to do next? I'm going to go to 133. So I change the perspective, and what do I get? More of the same. Still energy at the top. Utilities at the top. Staples at the top. Healthcare. Materials. What's below the market? All our growth sectors, discretionary, financials, technology, communication services. Links, John says, yes, I will send you both the spreadsheet and the links in that request. Absolutely. Absolutely. Thank you, Teresa. She said this is awesome with a bunch of exclamations. I promise that's what she said. Everybody knows I love good compliments. Thank you, Teresa. Okay, so now what? So now we're seeing that there's not a lot of rotation out of these defensive things into more bullish things. We might start to see that. We won't see it unless we continue to move down the road, down the line. So now here's 66 days. What are we looking for? Change, but there's not. Still energy at the top. Still utilities at the top. Still staples. Still healthcare. Right? What's at the bottom? Still communication services, still technology, still financials. We just haven't seen money flow into growth segments. It's very defensive. So as of right now, what am I expecting? More of the same. Let's go down to 22 days. On 22 days, what do we see? Is there any change? Now on 22 days, all of a sudden, energy's no longer leading. But does that mean we're seeing a shift to more growth-oriented sectors? No. Now staples is leading, followed by utilities, followed by healthcare. What do you need? When it comes to things we want, like travel, right? Like technology, things like that, very much to the downside. This is very defensive, right? In fact, this is one of the components I scored the most to the downside. Out of a 1, this is a minus 0.75. This is about as bad as it gets, quite honestly. I mean, it's not a bear market by any stretch, but certainly this is showing to be, from a sentiment standpoint, from sectors and what the institutions are doing, it's very lackluster. There's not a lot here that says, hey, we expect this market to reverse. A lot of concern. Yeah. Okay. So that's 5 out of 6 components. The last one, you guys know I'm a huge fan. I'm an evangelist for the VIX. I worship at the altar of the VIX. Okay. Now we're back to 2 points. Right? Now we're back to 2 points. And in this situation, it is, oh, sorry, before, one other thing. If you were to kind of just use this is where I would just come down and I'd be like, okay, utilities, strong, staples, healthcare. And then kind of at the very bottom, I would say energy, because it's strong overall, but it's dropped a little bit on the last one. And that just sort of organizes me. I ebb and flow with it. I found it to be helpful. You can see I got a little lazy. It looks like I think I have those on my other spreadsheet. Like I said, I tend to teach from this computer and run my analysis on my laptop. So I have it kept in different places. But sorry, let me actually put this here. Last component is the VIX. 2 points. What am I looking for out of the VIX? The primary consideration is escalation or de-escalation. If it's escalating, we tend to score it more negatively. If it's de-escalating, more positively. So we look for these transitions, lower highs, or like we had here, higher lows. So in the transitions is where we're going to tend to go from a negative score to a positive score, or in this situation, a positive score to a negative score. That's the easiest way to look at that. And people are like, well, then what's the formula? There's no formula. It's 2 points. It's 2 points. So now I actually scored this. I'm gonna try to erase. No, what am I gonna do? I'm gonna get rid of the last 2. candles. Okay, we're going to pretend like those candles aren't there. I can't really get rid of them all the way, but at least I've ghosted them out a little bit. Okay, so actually, let me do this. Sorry, I'm going to make it even better. Let's do that. This is what I saw on Sunday when I analyzed this over the weekend. So what do I have going on? What I have going on is a downward move that broke to the upside and pulled back and made a higher low. So right when I got a higher low, things are going to go negative. I mean, it's that simple, right? That is a fast early warning sign that says things are getting worse quickly. In our trading room, we hedged off of this signal. It worked out great. I hedge off of the VIX regularly. Now, if you look back at higher lows, you can see we had a higher low back here. We had a higher low. I kind of zoomed in a little bit back here. But how would I score this? As it came down, I was actually thinking, hey, this looks pretty good. Then it got a little bit neutral. And now what? Now I'm going negative. Right? Now, am I a -2? Of course not, because I think this thing could very easily come down. Well, let's play this back out now. Okay. So so where do we see higher low escalations? There's a higher low. There's a higher low. This one was not. This one was. There's a higher low. Anytime that you see something like this, what does that tell us? Higher low means negative. Absolutely right, John. What tells us that the institutions are increasingly putting on hedges. They're hedging. Why? Doesn't matter. They're scared. They're worried. They're nervous. Put an adjective on it. Doesn't matter. The institutions are increasing their hedging. If they're increasing their hedging, they're stopping or slowing down their buying, right? And they're potentially going to sell in that environment. So what would make my score get more negative? If we came down here and then turned up again, boom, we go even higher, right? So you know, as of right now, I'm a -0.5. I could if I looked at it now, I'd probably say more like a -0.75 or even a -1 because it's escalating. The fear is increasing. Are we going to come all the way up here to the mid 30s, upper 30s? Maybe not. We might pull back a little bit, but if we only pull back a little bit and then we start to turn up again, what do we have? We have another higher low, another indication that the escalation in the sentiment is increasing. That would get my score to be even more negative. In this situation here, I am a -0.75. That's what I scored it at. -0.75. That's not right. No, I went to a -1. Sorry. I wrote my numbers down. -1. I had this wrong. This was -0.5. This was this was 0. This was -0.5. -0.5, -0.5. There it is. What is my overall score? -3.25. What does that make me? Slightly bearish, right? That definitely puts me into slightly bearish territory. As soon as I get above a 2 or below a -2, I get into bullish or bearish territory. Between -2 and +2, it's more neutral, right? But like I said, I can be neutral but trading bullish. I can be neutral but trading bearish. What am I right now? I'm concerned, right? I am absolutely concerned. This market is showing a lot of defensiveness, a lot of fear. We're seeing increased volume on selling days. So as of right now, what would this say? It would tell me not to, number one, my risk level should be much less. than it would be in a bullish market. Number two, the sectors that I search should be these sectors: utilities, staples, healthcare. I want to have good stocks from these sectors on my list. Number three, what about my time frames? It's a choppy market. My time frames are going to be less. And what I'm going to be looking for are signs of improvement. When does this start to show signs of improvement? Where will I see it? Don't know yet. It might be out of the long-term trend. It might be out of the short-term trend. It might be the major market. We really don't know. And again, if somebody else said, well, my score is -4, or they said my score is -2.5, am I going to be like, oh, you're wrong? It's clearly a -3.25. No, that's not the exercise here. It's not. It's all about, have we considered all of these 6 components as objectively as possible? Teresa said it's subjective. It is subjective because it's our analysis, but we're trying to be as objective as possible. You'll notice I didn't say like, well, this event's coming out. What do you see? Not what you think, not what you feel. What do you see? Do you see an uptrend, a downtrend, or a sideways trend? On the long term, I saw sideways. On the short term, I saw slightly down. Is there some subjectivity where you might go -1? Yes, and that's okay. That is absolutely okay, because if you're a -4 versus a -2 versus -3, you're not going to fundamentally do things differently from that. However, as you see it changing, you'll see it. Have I ever been minus? I've been as low as -6. I don't think I've ever gotten below that. I can't remember now. Maybe 7. And I've gotten up that high. It's very difficult to get to like a -7, -8, or +7, +8. That's very difficult, right? I mean, if I get to a 5, I'm like, I am bullish, straight up bullish. If I get to a -3, I'm like, oh, -4, I'm like, oh, watch out. Be careful out there. Be willing to trade bearishly, right? We talked about it today, that if this market rallies up a little bit, right? If this market rallies up a little bit, the VIX is going to come down a little bit. And if it turns higher low, right? And if I were to translate that to the S&P 500, if the market were to rally up a little bit, but not much, and turn over, that looks like that. That makes me think that's happening. And if that happens, I want to make money on it. So you have to be ready for that. Is this the kind of market where we should be thinking about that? Yes. Yes, yes, and yes. So right now, should you be like, oh, let's go find some great tech stocks? We tried. We back in April, there was like a little hint of financials and technology trying to come back into favor, and it just sputtered out and failed to launch. Great. If that's what happens, that's what happens. Market in your posture, make sure that you reflect that and then trade accordingly going forward. So do I think we may be stuck in a market like this for a few months? Yes. Unfortunately, I do. With the whole sell in May, go away mentality that we tend to have, coupled with, the invasion in Ukraine, shutdowns in China, hyperinflation, it's not great. So be careful. Be ready to speculate to the downside. If it's going to go bearish, let's make some money, right? We're traders. We're not investors. We're traders. And that's why the butterfly helps. Absolutely. Right? Absolutely. Okay. Well, there it is. Right? Now what? Now we should be able to decide how much risk we take. How long we think. We don't have it listed on here, but these are the implications you should be thinking about. Based on this happening, it's gotten worse. If it's gotten worse, should you take more risk or less risk? Probably less risk. Should you stay in trades for a long period of time, or if you get in a trade and it's making some money, book a gain, at least half of it, and manage things a little bit more tight? Yes. Less risk, less trades, less time, more aggressive managing, That's the market that I'm in. Butterfly, what types of trades should we be considering? Well, the VIX is going to help us understand what option strategies make sense. So this forces you to look at the VIX and understand what's happening and how do I translate that into my trading. So I tell people all the time, I don't decide what to trade. I shut up and listen and let the market tell me, what should I be trading? Where should I look? Where's the money going? Right? Is it changing? Is it clear and I can be aggressive, or is it a little bit like fuzzy and I should relax? And I told people this in the trading room today. Trading is not linear. You can't just do the same thing all the time. That's crazy. Stronger market, you're going to be more aggressive, trade more, hold longer. I mean, right? And you're going to try to make as much money as you can as long as the conditions are good. The whole time watching to see if conditions start to erode so that you can start to hedge to make sure that when we hit a correction, you're not, taking huge hits. So there you go. All right. Any last questions? I'm going to send my email one more time to anyone who didn't get it. And you can just send me a request that says, can you send me the spreadsheet and the links? And I will do that. And give me a couple of days. Don't. Sometimes I'm slow responding. I'm going to leave here right now and go watch my daughter play a soccer game. So it may be a day or two, but I will promise I will send those back. And then there's an old saying in the market: the blade of grass who doesn't bow before the lawnmower gets his head cut off. Well, my friends, we are a club of blades of grass. So what do we need to know? Everything we can about the lawnmower. That's what we're doing here. We've considered many different components as objectively as possible. And now we should have a stronger understanding of what this market is. All right. Well, it's good to see everybody. Hopefully you'll join me tomorrow for the trading room. If not, join me in 2 weeks for the next one of these active investor workshop presentations. I don't know what the next one will be. We'll stick to the schedule going forward, but hopefully you found this to be an interesting perspective on how to just sort of evaluate the market from week to week and just give you some guidelines and a framework to trade within. Have a wonderful rest of your day, my friends. And as always, happy trading.